Hello friends, welcome back to the next session on general insurance. Let's begin the learning. In this particular session, we'll be understanding and studying the various functions of reinsurance broker. The learning objectives. At the end of this particular session, you will be able to understand what do we mean by reinsurance and what is the understanding or the conceptual clarity with respect to reinsurance. And furthermore, we'll be understanding and learning or dealing with the various 6 functions that a reinsurance broker has to perform. Now let's begin the learning. What do we mean by reinsurance? Reinsurance is a process which has been done or undertaken by a reinsurance company to insure the primary company. So here in this case, let's take an example wherein there is a particular company which has been undertaken a reinsurance insurance contract, and in order to compensate a certain amount of money, what does it do? It has again taken a reinsurance contract or contract of insurance from some another company. So a company purchasing an insurance contract for an insurance company is called as a reinsurance contract. So the definition clearly mentions reinsurer company to insure the primary insurance company. So here in this case, what are we seeing? That there are 3 parties that have been involved. The first party is the insurer, that is the primary who has taken the insurance. The second party is the insured, that is who has taken that particular insurance. So initially we have a contract between the insured company and the insured person. And lastly, we have another participant which is also called as an reinsurer. So reinsurer is a particular person who has taken the liability or undertaking for protection of loss for the insurance company itself. So as an individual person's liability is being undertaken for protection of loss of the financial concern, in the same way, for protection of the rights of the insurance company, a certain contract is been given to the insurance company itself. And such type of contract is called as an reinsurance contract. The various functions that a reinsurance company performs. So majorly, there are 6 functions that a reinsurance company performs. Those particular functions are, the first one is capacity, the second is catastrophe, the third is stabilization, the fourth is financing, the fifth is enter and exit markets, and lastly, the sixth is utilize the reinsurer's expertise. Now let's look at one and one functions in detail. The first function, that is capacity. The function of capacity deals with a certain consideration about what type of insurance contract you are dealing into. The different types of contract that we have to deal with is whether it may be an insurance policy with respect to life insurance, general insurance, health insurance, and so on. Depending on the different types of policies, the insurance contract is being undertaken. Now, the capacity also deals with a certain consideration about what is the amount or on the basis of different categories or different portfolios. Which is again further divided into single risk policy, portfolio based risk, loss mitigation, and sharing of quota. The first policy that we have to deal with is single policy risk. Single policy risk deals with a certain consideration wherein you have to deal or you have to take an insurance contract for a single transaction or for a single company or for a single individual. Here in this case, the insurance company, if they have taken an insured policy for an insured person, now here in this case, only for a specific transaction, only for a specific individual, the policy, if it is being insured by the insurance company to the reinsurance company, then such type of capacity is called as a single policy risk, which is being given for just only one single transaction. Now it may again bifurcate, or it may again further get divided for a different categories. The another category is portfolio based risk. Portfolio based risk is a consideration wherein the policy or the contract has been given for different verticals. In the earlier example, we were dealing with only one single transaction, but the multiple number of transactions, multiple number of activities can also be undertaken, and accordingly, the risk or loss can be suffered or it can be divided between the insurance company and the reinsurance company. Portfolio policy risk or portfolio based risk is also been divided, or it also been categorized based on the concern of what portfolio you are dealing into. Portfolio is a combination or a group of policies which has been given to the reinsurance company, and based on the requirement of that particular client or the insurance company, the policy matters differ. And here in this case, either you may get a single policy or you may get a multiple policy. Another example that you have is in case of loss mitigation. The concept of loss mitigation applies wherein the a reinsurance company only concerns or only provides the coverage ratio for the loss that is being occurred by the organization. Let's take an example wherein a transaction or the policy is being taken for rupees 20 lakhs. But whenever the policy was being undertaken for 20 lakhs, a certain conclusion or a certain clause has been mentioned with respect to loss mitigation. And when the actual unfavorable outcome has been arised and the loss that has been suffered by the person, that is the insured person, is rupees 15 lakhs. So here in this case, whatever amount that has been mitigated or whatever loss that has been actually incurred, in that particular case, here in this particular example, the loss will be borne for only rupees 15 lakhs and not for the entire amount of 20 lakhs. So here in this case, the loss mitigation policy applies for whatever amount of loss that has been actually incurred by a person, that is by the insured person, only that particular amount is being shared, only that particular amount is being incurred and paid to the insurance company. And in return, from the reinsurance company to the insurance company and from the reinsurance company to the insured person. That is the concept of loss mitigation. And lastly, the sharing of quota risk. Now, sharing of quota risk is a particular concern wherein the company may divide the amount of risk of loss that is going to be occurred. Let's take an example. Now, a particular insured person has taken a policy for rupees 10 crores. Now, when a policy for rupees 10 crores it is been undertaken, the condition or the clause that can be made or can be insured is sharing of quota. Now, in case of a sharing of quota, this particular contract applies or incurs between the insured company and the reinsurance company. That is, whenever the actual loss or the damage will be taken into consideration, the loss or the risk of loss will be divided into the percentage. And supposing the percentage is divided as 75 to 25 or 80 to 20. So here in this case, if the actual loss that has been incurred is rupees 10 crores, then accordingly, the percentage will be decided between the insured company and the reinsurance company. If the reinsurance company is supposed to pay 75%, then accordingly 7 crore and 50 lakhs will be paid by the reinsurance company and remaining 2 crore 50 lakhs will be paid by the insurance company. Or in the other example of 80-20 percentage, 80% will be borne by the reinsurance company and 20% will be borne by the insured company. So here in this case, what is the capacity? So based on that particular capacity, based on that particular coverage, based on the amount that has been decided, the risk of loss is being shared between the companies. So here in this case, the capacity can be either for a single product or for a multiple product or for various loss mitigation, that is actual loss that has been incurred, or for the amount that has been decided mutually between the insurance company and between the insured company, that is the reinsured and reinsurance company. Another function that the reinsurance agent has to perform is the amount of catastrophe. It again considers the situation of quota sharing, excess of loss and securitization. Same in continuation with the earlier example, the quota sharing. This particular quota sharing may be at a certain percentage, that is 50% or 50%, 80% or 20% or entire 100%. So catastrophe is a particular situation depending upon the mutual agreement between the parties. If the risk of loss is much higher, if the risk or the loss that is being occurred is much greater, then accordingly the catastrophic situation that is been into existence, based on the situation, the proportion or the percentage can change. So flexibility in changing the quota sharing, that is earlier it was 75 to 25, now it can get changed to 80 to 20 or 85 to 15. So here in this case what we are looking for, based on the severity of loss, based on the loss that has been actually incurred, the percentage of quota sharing can change or it can differ. Excess of loss. Now here in this case, for example, the earlier example we'll continue with. The loss that has been incurred or that has been valued by a certain company is, for example, rupees 10 lakhs or rupees 20 lakhs. But the actual loss that has been incurred, the valuation goes up to rupees 15 lakhs or rupees 25 lakhs. So here in this case, what happened? Excess of loss. If a particular loss that has been incurred by the insured person is in excess of the amount that has been secured or it has been insured, then accordingly the reinsurance company has to pay or will usually pay an additional amount. So catastrophe. Catastrophe is the severity of loss that has been suffered or incurred by a particular person. So depending on the severity, depending on the amount, depending on the valuation, depending on the evaluation that is being done, the amount of loss is being incurred and it is being paid to a respective individual. Next, we have the concept of securitization. Securitization is a concept wherein what security do you provide? So based on the security that has been given. Now let's take an example. If the insurance policy that you have taken is for rupees 20 lakhs and accordingly the security that you have provided for the remuneration or reimbursement of the insurance policy is of rupees 10 lakhs. So based on the concept or based on the applicability of the concept of securitization, what you will do, you will make an applicability and the claim will be finalized for only 15 lakhs or rupees 10 lakhs, whatever may be the valuation of that particular security. So in this case, the catastrophic situation applies with respect to the underlying asset that you have shared for. Now let's move towards the third function. The third function, that is the stabilization. In terms of stabilization, we have different types or different varieties or categories. That is swings, variance reduction, stop loss situation, or aggregate or average situation. So in terms of swings, the profit may either increase or the profit may decrease. The loss may either increase or the loss may decrease. So depending on the change in the market situation, depending on the stage changes in the considerations, we have to identify, we have to deal with what actual loss has been incurred and whether the loss is either at an increasing stage or at the decreasing stage. Depending on the swings, that is ups and downs into the market, the stabilization policy is being adopted and accordingly the loss is being compensated to the individual, that is the insured person and the insurance company. Variance reduction. Variance reduction is a particular concern wherein in order to reduce the risk of loss to a particular individual, certain measures have been undertaken by the reinsurance company. That is provision of lifts, provision of firefighting system, provision for security of the personnel and so on. So in order to reduce the risk of loss, what other measures have been taken by the insurance company? Those measures are simultaneously taken by the reinsurance company itself. So those particular measures for reduction of risk of loss in terms of stabilization are called as variance reduction. Another concept that we have at this particular stage is stop loss situation. The concept of stop loss situation deals with the consideration about at a certain stage, the particular loss that has been expected must not go beyond a set target or beyond a set limit. So here in this case, a certain clause or a certain condition is being laid by the reinsurance company, wherein they always deal in a certain transaction that beyond. Now, for example, if your insurance policy is rupees 20 lakhs, and the certain condition that is being laid by the reinsurance companies, the risk of loss will be paid to up to rupees 18 lakhs. So here in this case, what happened? The stop loss situation is being applied. That is, if the loss is beyond 18 lakhs or if the loss is uh, between 18 lakhs or not above 18 lakhs. So here in this case, if maybe either inside 18 lakhs or outside 18 lakhs, this particular concern, the insurance company will pay a definite sum of money of rupees 18 lakhs only. So whether the amount goes beyond or the amount goes within that particular range or a particular limit, the stop loss situation will be able to concern that the loss or amount will be secured in a better position. And lastly, the aggregate or the average situation. The aggregate or the average situation applies to a certain concern wherein the condition has to be seen that whatever loss that has been incurred, all the average of those particular losses will be taken into account, and based on those concerns, the loss will be incurred or it will be suffered or it will be provided. So aggregate of all the transactions. Now, if it is a single policy, then it does not apply. But if it is a portfolio based policy wherein the combination of different policies is taken into consideration, then accordingly the average of all those particular policies will be taken and the valuation of risk of loss will be identified. Next function that a reinsurance broker or the reinsurance agent has to perform is in terms of financing, which deals with liabilities reduction, commission overrides, transaction savings, finite reinsurance and financial reinsurance. So at every stage, the particular individual reinsurance broker has to see that there is a proper set of balances in terms of financial analysis that has been done. Always at every stage, the reinsurance broker has to see that the liability of the insurance company is being reduced to a minimal level. The liability is needed to be controlled and accordingly based on the control in the liability, the profit sharing percentage or the margin between the reinsurance company and the insurance company is being set. And whenever active measures or modes have been undertaken for prevention of risk of loss, the risk of loss that is being suffered by the insurance person is also being reduced or minimized, and the risk of loss for the insurance company is also being minimized. Commission overrides based on the commission that is being set. So always a certain amount of commission or a percentage is being set between the parties. Now, who are those particular parties? The insurance company and the reinsurance company. So between those two parties, the commission percentage is been decided about for providing or rendering of services. Next concern you have is with respect to about how the risk of loss is being shared by different people and in what ways the functions of remuneration can be performed by the different parties. Now, these particular functions can be either performed at the individual level or at the composite level. Now, the finite insurance and the financial reinsurance, it is between the parties who are undertaking a certain amount of transaction at the commission level or at the mutual agreement level. The next function that we need to see is enter and exit market. In respect to the enter and exit market, there are three different categories: the risk minimization, the question and answer sessions, and when and how watchdog. So here in this case, the reinsurance company is also needed to see that the risk is always minimized and accordingly the risk of loss is also being controlled. Question and answer session, always there should be a proper watchdog situation wherein the company, that is the reinsurance company, should always question and the insurance company must always answer whatever doubts that have been raised. Based on the queries that have been raised, based on the question that have been raised, a proper session needs to be organized and we need to see that various measures have been undertaken for reduction or minimization of loss. And lastly, the sixth function, that is utilizing the reinsurer's expertise. In order to utilize the reinsurer's expertise, we have various number of transactions, that is large or small claims, unused or unutilized claims, large amount of risk, unidentified risk management, and special knowledge or care. So a reinsurance company has always need to see that whatever the amount of claim it must be, whether it is a large claim or whether it is a small claim, a proper expertise, proficiency, skill and guidance must be provided, and accordingly proper treatment or equal treatment to all the parties or the policies or the insurance companies must be given. Unused or unutilized claims. Any claim which has been given or which has been raised by a certain company, it must not go unused or it must not go unutilized. All the claims that have been made or that have been created must be satisfied or must be fulfilled within a specific deadline or within a specific time period. A case wherein there is a large number of or a huge amount of risk that has been involved, a proper care, a proper guidance and proper negotiation and proper involvement of the reinsurance company is needed, and accordingly proper care should be undertaken. And lastly, special knowledge and unidentified risk management. So in case of risk management, whether the risk is favorable or unfavorable, identified or unidentified, the reinsurance company must be very careful about understanding those situations or norms of controlling the business operations and activities. Now let's summarize what we have learned in this particular session. In this particular session, we have dealt with or we have understood what is meant by reinsurance, what are the various 6 functions the reinsurance company has to perform, and we have also dealt with each and every individual function in detail. I hope you must have enjoyed the learning. Thank you.